Hello, everyone. This is Craig McGrother, the host. This is Riffs with Rob, hosted by myself, Craig McGrother.
Pleasure to be here. We're here in
Yes.
Dallas.
The date is, just so we're all sorted and clear, June 14th. If you guys want to send me birthday gifts in 2 weeks, my birthday is June 28th, but that's neither here nor there. What has gone on since we last left off?
So the last time we had a podcast was in Cabo. We were at Hunter's Mastermind Retreat. That turned out really amazingly. You know, as they say, when you go to an event like that, you can get overwhelmed, but at the end of the day, all you need is that one connection or that one key piece of
Right.
knowledge to take you to the next level. And I think we definitely left with one of each.
Yeah, and it's really cool to be in rooms like that, as we were speaking before, because the cost to enter that room was not a cheap ticket by any means. So it was really cool to be around people who are investing so much in themselves and into their career and to grow it. That paired with the connections, as you just mentioned, was really incredible. I had a couple of really nice key takeaways. I think us taking more initiative and action into what we're talking about here and just starting this show really stemmed from that, which is awesome. So anytime you can get some juice and kind of capture that lightning in a bottle is always incredible.
Yeah. So as I mentioned, now we're here in Dallas. We just flew in to record some property videos. We're going to meet with some brokers here in town, host an investor dinner tonight. So we're making the most of our time, wouldn't you say so?
Yeah, absolutely. And Dallas is a really cool city. I mean, it's really fun Dallas has obviously been a known thing for a while, but there's a buzz, there's an energy in the city. Obviously, we're doing business here now. This is our second property that we're working on this year, and then also the second Lone Star property that we'll be acquiring in Dallas, which is super exciting for those who are watching. Our goal this year was to acquire $100 million of real estate in Dallas this year. We're hoping to push through that, and we're actually getting almost halfway to that goal once we close this deal.
Yeah, that's right. That's exciting.
Yeah, so awesome. Well, without further ado, the theme that I want to start with and to discuss in this one is the topic of hard to buy at all points in the cycle. So, kind of elaborate on that one. What does that mean? And, where are we at in this cycle, would you say? And maybe talk about the ending of the last cycle that we're in, because it's definitely the changing of the guard right now.
Yeah. All right, we're jumping right into the meaty stuff.
Yes,
So
yes.
getting me excited. So this is a concept that I've kind of developed over time as I've studied economic history and looked at the global financial crisis in 2008 and the previous recessions and kind of the heated up market of the last 5 years or so as things have gotten really expensive and really competitive. And it's funny because when you bump into people in our industry, people always ask, oh, well, how hard is it to find deals right now? Or how hard is it to raise money right now, right? Which are two separate things completely, but they are linked, and we can talk about that as well. But the thing about this concept of, oh, is it easy or hard to find good deals right now, right? And the reality is it's always hard to find good deals. It doesn't matter where you are in the cycle, because if you think about it, even in, let's say, 2012, which might have been the best year in history to buy real estate.
Right.
People probably in 2012 were sitting around telling each other, oh, it's so hard to find a good deal right now. Things are too expensive.
And yeah, cost per unit was probably too high when it was, likely, whatever, a fraction of what it's selling for per door right now, which is crazy to think about. And,
Exactly.
yeah.
People were thinking, oh, we're going to go double dip. There's going to be a double dip recession. We're going to go into
The
another
market will
recession.
never rebound.
Right.
Yeah.
So the reality of how the market works is it's quite simple, right? The person who most likely buys the deal is the person who's willing to pay the most, right? So whoever's willing to pay the most is the fool that is willing to outbid everybody else, right? So even if it's 2012 and it's an amazing time to get into the market, or it's 14, 15, 16, all those years were amazing years to buy real estate.
Well, and I remember in 2016 when I just started doing real estate, people were talking about, oh, well, the cycle's almost going to be over because historically speaking, and obviously economies change, they grow, they become more robust, there's just more jobs, especially technology, growing sectors and such, and maybe that's coming up here with AI, but it's interesting because I remember call it around 2016 to 2019, everyone's like, well, the recession's going to come because historically speaking, it's every 8 years or so. And, obviously 2009 is when the market kind of bottomed out. And then you have that tarmac and then boom, it was going to change. But in fact, that didn't happen at all.
Right. So there's a couple takeaways from this concept. And I feel like we kind of breezed over this concept that has taken me years to kind of really wrap my head around. But just basically, if you play along with this idea that it's always hard to find good deals, right? No matter where you are in the market cycle, it always feels like a stretch to win a deal, right? There's never going to be a situation where you show up to the bidding and you submit the offer and you feel really good about your offer and we're stealing this deal, this is amazing, right? 9 times out of 10, there's a competitive bidding environment that forces you to kind of push slightly out of your comfort zone. Hopefully you stick to your underwriting parameters and you don't get over your skis, but you're not going to necessarily just be able to buy the deal. All the numbers just make a world of sense and it's easy times, right?
Yeah, so you said it's a stretch. What makes it a stretch, right? And then not only what makes it a stretch, but how do you get over the hump? Do you have to massage certain numbers? Do you have to feel more comfortable with a certain area? And what do you green light versus red light? Because there's been properties where it's like, okay, you will do it for a certain reason. There's times where it's like, oh, absolutely not. Is that because of a vintage? What gives you that green light that makes you just a little more comfortable versus other properties? Because obviously we bet on tons of properties every year. That doesn't mean we buy tons of properties every year.
Right. So when we're talking about you asked why do things get stretched, right? It's just the makeup of the market. If we're competing against buyers just like ourselves, right? They're plugging the numbers into their model, we're plugging the numbers into our model, and we all want to buy the deal, right? So we're all forced against each other to stretch, right? And that's to the benefit of an efficient market so that the seller is able to get their best price, and so that when we are sellers, in turn, we can go out to the market and create a competitive bidding environment and get the best price, right? So real estate's not an efficient market as compared to the stock market, but it certainly isn't, there's no secrets like we say in real estate, right? Everybody knows that Dallas is one of the best markets in the country. That's why we're here, and that's why there's a ton of sponsors all around the country here to bid on the deals here. So that's
and a lot of new players that have never been in Dallas, maybe never been in Texas, but identify Dallas as an incredibly safe hub to be a part of.
Yeah, and the thing is what's interesting about that is for the last few years it's been so competitive that it's been really hard for new entrants to get into the market. And while we're pretty well known, we were a new entrant because we hadn't owned anything in Dallas. And so two things are in our favor now. We bought our first deal in Dallas. That's a big win. And now the market has slowed down such that it's a better time for us to build relationships and really establish our presence and whatnot. So I'm excited about how those factors are at play, giving us a better opportunity to really take advantage of the market. And I think it's just the beginning as well.
Right, and you said, on the end of getting into the market, why is it hard to get into the market? What are the barriers you have to face when you are, trying to crack through and break through, especially with a competitive place like Dallas?
Yeah, so let's talk about that, and then let's go back to the question that you asked about how do we green light, red light, right? And how do we?
I'll note that. Yeah.
Yeah. So take Dallas. Let's use Dallas as an example, right? It's such a competitive market. The standard offer has hard money, right? And that's mostly true around Texas.
And to what amount of hard money is associated, and what is hard money in that regard? So just break it down in the most simple form, please.
Yeah. So when you put a deal under contract, you're most often obligated to put some sort of earnest money deposit down, which is basically kind of like your initial deposit to actually put the deal under contract, right? Because no one's going to let you buy a $50 million deal without some sort of initial skin in the game, right? And that initial skin in the game, known as your earnest money deposit, that can be refundable or non-refundable. And then there's all these sorts of clauses as far as, okay, well, is it refundable if this happens, right?
Yeah.
So there's nuances in the contract, but in a simplified version, right, you have non-refundable earnest money where basically you put the money up the day you sign the contract and that's it. If you don't close, you lose that money. And in a competitive market like Dallas, that's standard, and the number can get quite big, and it's something like 1% to 2% of the purchase price. So to put that into perspective, if you're putting a $50 million deal under contract, you could be expected to put up a $500,000 to $1 million non-refundable deposit the day you sign.
Which is incredibly difficult to do if you're also a newer sponsor, right? Putting up that amount of money is just frankly for the most part not doable. And also to mention, to satisfy what a lender needs to have a net worth profile and such to make it happen. It's just, this is not an easy game to get into or to play on so many fronts. And I think, that can't be stated enough, frankly.
Right. And so especially when the market's super hot, because why is the seller going to spend their time trying to nurture along a newer entrant, a newer buyer that
They
has
want
more
certainty.
risks?
Yeah.
Exactly. They want certainty. The price is the price. There's going to be a buyer out there who's going to be able to deliver on their price and on their terms.
Right, right. So talk about green lighting a deal and then red lighting a deal. What are the things that you look for that, you want to get married to, and what are some things you want to detach yourself from?
Yeah, so just as an overview of our strategy at Lone Star Capital, right? We look for value-add multifamily properties that we can acquire and improve the operations operationally or through renovations on the interiors and exteriors. And some nuances that we also have done are affordable tax exemption strategies. And we've also, we do smaller things like tech packages. So we're always looking for small ways to add value, right? But by and large, we're targeting 1980s, 1990s vintage properties so that they're a little bit dated, where we can add value, right? If we're buying a brand new property, that really doesn't present us much of a value add opportunity. So that's usually not our profile. So within our profile, the types of deals that get us excited are deals that are, I would say, above 150 units, right? That's kind of an easy screener. And most recently, we also added the 1980 or newer screen as well, because we own 1970s deals in the portfolio, right? And we've been actively bidding on 1970s and even 1960s vintage assets. But I think at this point I don't want to say learned our lesson, but we want to focus more on quality assets that we feel comfortable with and are comfortable holding long term. So I think that's a major upgrade for us to keep us focused. And speaking of focus, we can't spend our time looking at hundreds of deals every month, right? We could, right? And we could hire more people and we could spend the effort to look at every single deal in the market. But I don't think that's an efficient use of our time. I think instead, if we can establish these initial pre-screeners, we can then spend more time on less deals and really get to the bottom of things more efficiently. So that's been kind of somewhat of our approach, but I think we're really leaning in and going all in on that sort of approach where we pre-screen harder and then underwrite and due diligence fewer deals so that we can really get to the best assets.
Do you have any examples that come to mind where you didn't feel comfortable necessarily, or maybe you felt your skin crawling a bit, but you said yes to a deal and then you're super excited about it in hindsight as, the deal has kind of evolved, maybe the business plan has kind of gone through? Do you have any kind of case studies of that mentally where it's kind of made you feel more confident as, we progress through?
Yeah, I feel like a few deals work out that way where, the bidding situation gets aggressive and you're really squeezed to the max in your numbers and you're looking at the numbers in the model.
Start getting maybe a little emotional and tilt, if you will.
Yeah, and you're looking at the numbers and you're saying, oh, can we really do this? Are the returns too low now? Because obviously there's an inverse relationship between price and projected returns, right? The more you pay, then the lower the projected returns are, right? So, yeah, so you're going back and forth in the bidding, you're looking at the numbers, and I feel like that often plays out. I mean, to a small degree, I felt that way about our first deal here in Dallas, Candlelight Park, because frankly, Dallas is just more competitive, and the numbers are tighter in Dallas than they are in Houston. So, given the fact that we've bought, I think, over $300 million in Houston, we're familiar with the market, we're confident in the market, we know it well, right? And then you go to Dallas, and you can feel it. Just there is that step change of how tight the numbers are. It's more competitive. And I think we felt that with Candlelight. But then as we went through due diligence and the process, and we kind of got to know the numbers better, we really just felt more and more confident about the deal. And of course, getting the feedback that we've gotten from brokers and owners, that are our peers in the market, everyone thinks it's a great deal. Everyone is super
Yeah, our
impressed.
partners have raved about the deal, and I think as time has progressed, we wish we had a dozen more of those that we could buy right now. But unfortunately, not every deal is like that one. It's not, served up like that. So, that's why I was just curious to know. And then, is there any deals in Houston that have made you feel really good in hindsight that you kind of pushed through?
Yeah, but there's a couple that come to mind. I mean, one good example is Verandas at Bear Creek, because we've at this point bought and sold that property. So we've seen the full cycle on that deal, and we've had ups and downs on that deal, but mostly ups. It was a really smooth deal all in all. The trouble that we had with the deal was that it suffered with lower occupancy at the time we put it under contract.
Yeah. Well, I remember I was actually speaking to, and I told you this story, I was speaking to a potential investor, and he said, I know you guys really well because I actually used to live in that area, and it had a terrible reputation, and he was stunned by the turnaround that Lone Star was able to do there, which is just, A, for the community, it's an amazing story. You don't want to have, crime-riddled properties where, people don't feel comfortable just walking around. That's just terrible to think about. Just from a human element, but then to go in and to implement and execute a business plan like that is really awesome. But, in hindsight, do you think you would take on a property like that again moving forward?
Yeah, absolutely. So, and that's a good question.
Because the occupancy was like 88% or 80%?
It was closer down to 80.
That's really tough.
Yeah. We've done worse. And the thing that was unique about that was, and this was the struggle, it wasn't just low occupancy because there was a few things to fix and boom, now you're full. The property was already in good condition. So the occupancy issue was solely a management problem. So who were we, couple of guys from New York, coming down to Houston and saying, oh, we can manage this property better?
And I'm sure some people are probably laughing that we're, kind of insiders, if you will, in the Houston area to that point.
Yeah, and that's something that I actually want to cover at some point as well, to kind of talking about the California to New York to Houston.
We'll have a management episode, yes.
All that stuff. But that was the gut check, the soul searching of that deal, which was, okay, do we really think that we can buy this property at 80% occupied and lease it up to 95% while virtually spending no money, right? You feel a lot better about a business plan when you're throwing money at the property, right? If you're buying a deal for $10 million and you're planning on spending $2 million on it, that you can just look at the spreadsheet and kind of visualize the business plan and get.
Yeah, that's been done time and time again. That's that's the business.
That's called house flipping, right?
Yeah,
everyone can picture it. Everyone can understand that.
Yeah.
So that was a soul-searching moment of, okay, are we really that capable? Do we really understand the market well enough to bet on this management play? And fortunately, we were 100% right. Our management team executed and took the occupancy all the way up to 100% and totally crushed it. So that was an amazing deal that we were really fortunate to have as our second acquisition.
Awesome. And then just to go back on this theme, any more green and red lights that you want to go over that you have to push on?
Yeah, well, what I want to talk about today is where we're at today, which is
right.
Interest rates have come up. That's caused transaction volume to come down because, of course, buyers are forward-looking. So when they're plugging in rates into their model, they're looking at lower prices. Sellers are clinging to yesterday's price. We've got that bid-ask gap.
A lot of people are worried about, what's going on with the economy. I think we're a little bit more sheltered in Texas because I think there's more jobs and just a more pro-business state, which is why we're here to start with. But there's a lot of investors and equity people that are just, skeptical to say the least. So
yeah, and I myself am skeptical, right?
Yeah.
I worry about a recession coming and all that good stuff. So there's a lot of things looming over the market, and that's pushed up cap rates. Not a ton, not enough to really make it so that we have a functioning market, if you will. And by functioning, I just mean a 10% bid-ask gap where that gap can be bridged and we have healthy transaction volume. Right now transaction volume is down about 80%, which is a huge dip.
It's incredible. Is that multifamily alone, or is that all of commercial real estate?
The statistic that I'm referencing probably refers to,
I think it's all commercial.
All commercial real estate, but just anecdotally from what I'm hearing from the brokers and just see what we're seeing in the market, it seems like multifamily is down just the same.
Right.
And the reason, I mean, just to get a little off topic, the reason for that is because if you're a seller right now, or if you're an owner of multifamily right now, why would you sell, right? If you have long-term debt, let's even say you're in great shape and it's fixed rate, right? If you have long-term fixed rate debt in place, why would you sell right now when valuations have dipped down, right? You're going to hang on, continue to cash flow, and probably look to sell at a later point. So that's one of the reasons why there's less deals getting done, is because there's less people motivated to go to the market and sell. And then on the buy side, buyers are just plugging in the numbers and they're not making sense. So the point I wanted to get to on that is, because we're talking about how do we get the numbers to work, right? How do we kind of squeeze the numbers, if you will, as necessary to win a deal? And one of those ways is with your exit cap rate, right? And customarily, people usually take their going in cap rate or the prevailing market cap rate and they widen it by, let's say, 50 basis points. So let's say the market cap rate today is 4.5%, which means that for a stabilized Class B multifamily property, it trades for a 4.5 cap. You would put in your model the exit cap rate, which is the cap rate or the price that you project to sell the property for down the road, whether that be 3, 5, 10 years.
And can you explain maybe what cap rate means to some people that don't know what it is? Because there's some people that might be watching that don't know. So just real quick, if you could just break that down in the simplest terms, that'd be great.
Yes. So a property's cap rate is its net operating income divided by its purchase price.
Okay.
So it's its unlevered earning potential, meaning if you were to buy a property at a 5 cap and you were to put no debt on it, you would essentially be getting a 5% cash on cash return. You'd be making 5% on your money every year, because the 5 cap indicates that the net operating income of the property is 5% of the total price of the asset.
So essentially, if someone were to buy something for $1 million and it was a 5% cap rate, that means cash will be $50,000 for the year. Is that correct?
Right, if they were to buy that property just all cash,
right,
keeping things simple, right?
Okay.
So then that's what a cap rate is, just generally speaking. And then specifically in underwriting, your exit cap rate is the cap rate that you use to value the income that you are projecting out in year 5, for example. And so the cap rate formula is kind of the most basic building block of commercial real estate, right? And the cap rate formula, let's just go over it again. It's value or purchase price equals NOI divided by, I'm getting things mixed up. The cap rate equals the NOI divided by purchase price, right? And I was getting ahead of myself. So that's the basic building block calculation. However, the much more interesting version of that calculation is actually when you move things around. And it's when you move price from the denominator over to the other side of the equal sign and you bring cap rate under NOI, right? And that's the kind of the calculation that people in the industry think about much more often, which is, okay, a property has $1 million of NOI, capped at a 5% cap rate, that means it's a $20 million property, right? We think about property value in those terms.
Right.
So when the point we were getting at is if today the cap rates are 4.5, typically we would project out a 5% exit cap rate, right? And that's just kind of conservative best practices where you would widen the cap rate by 50 bips. However, today, we've seen cap rates kind of creep up a pretty substantial amount. And of course, nobody has a crystal ball, but there's people out there that believe that cap rates will come back down. Maybe not down to peak levels where, in Phoenix, things were in the 2s, but they think that cap rates are kind of somewhat abnormally high right now and that things are going to come down. And so rationally speaking, then, why in your projections would you widen out the cap rate further if your thesis is that cap rates are a little bit wider today?
Right.
Right. So I'm actually starting to see very sophisticated, larger sponsors out there use pretty much a flat exit cap rate in their underwriting, which means, let's say today they're buying the property for a 5 cap and they're projecting to exit for a 5 cap as well. So to some people, I'm sure to many people, that sounds aggressive, right? And that could be aggressive. It just depends on the deal, depends on the market situation, right?
Maybe the sub-market, where you're at, how you feel about it. I mean, there's some places, from the last cycle, like the Bay Area, which that completely dominated. There's other places that didn't, right? So,
Right. So there's a lot of factors at play, but I think what the point I'm trying to get at is the exit cap rate and kind of taking a more thoughtful approach there. Yes, by lowering your exit cap rate and maybe making it flat, for example, to your entry, that's considered aggressive, but maybe that's the lever that you need to pull, and uh, maybe that's the place to be aggressive, right? In order to actually win the deal, because obviously, if you lower your exit cap rate, that's going to project a higher future sales price, and that's going to make your overall return projections look more attractive, which is going to entice you to buy the deal, right? So that's one way, and I talk about this because the other way would be to get more aggressive elsewhere, which could be on your rents or on your vacancy or lightening up your expense load. And I think those are all ways to make a mistake. I think that is where you can get yourself in trouble, because if you miss on your expense projections, for example, that can be quite painful on a every single month basis from the very start of the project, right? And that can hurt your cash flow bogey. If you, for example, projected out 5 or 6% cash on cash returns out to your investors and you're wrong on expenses, that 6% cash flow could go down to 3% really quickly, right? So I don't think operations is the place to be aggressive, right? I think the exit cap rate, especially at a time like today where you can make that argument that, okay, well, maybe it doesn't make sense to widen the cap rate out as much as we normally do.
interesting. Okay. Very cool. What's one thing that a lot of investors, speaking of cap rates and yields and stuff, and widening, expanding, contracting, what's the one thing that we started hearing all over the place that people are looking for right now in this market? Call it from December to probably now, and I would imagine till maybe 2025.
Yeah, I think that sounds about like the right timeline. Positive leverage.
Yes. Yes. Can you explain what that is, just so people understand? Yeah.
Yeah. So we were talking about a cap rate
And yield.
and
Yeah.
yield, and saying, well, if you buy the property unlevered, then the 5 cap deal gets you a 5% cash flow. Well, the reality is real estate is built on leverage, and specifically positive leverage, which means that your cap rate is higher than your cost of debt. So in a perfect world, you would buy a property for a 5 cap, and you would finance that property with debt at 4% interest, right? And that would create a 1% positive spread between your cap rate and your debt, which would actually enhance the cash flow, right? It would take it up from, let's say, if you buy the property unlevered again, right, it's a 5% cap, you'd have 5% cash flow. But because you're buying on leverage that's accretive, meaning 4% debt versus your 5% cap, that might boost up your cash flow to 6, 7%. So the commercial real estate world loves positive leverage.
But is it easy to find?
Yeah, exactly. Is it easy to find?
Maybe in Wichita or, rural Mississippi, but, with all due respect to those markets. But when we're in Texas, we're in Dallas specifically, it's incredibly rare to come by. And I think people have extremely unrealistic expectations about that. And I don't know if that's because people are looking for excuses to not invest, but they're soft looking. But it seems as if it's a really easy cop-out for people to kind of reference back to that, because if you're going to buy in a growth market like Texas, like Arizona, like Tennessee, like Florida, the sweethearts, the Carolinas, you're just likely not going to find that.
Yeah, unfortunately, you can't.
Or it's really rare, I should say, at least
Right.
for 150 plus units and stuff. Maybe you can get a mom and pop seller that's a 40 unit that's owned it for 20 years and has maybe mismanaged it or something like that. Perhaps that is out there, and I'm a believer that someone out there somewhere today bought the best deal that will make them incredibly rich, and that happens every single day through the year, but extremely rare with what we're looking for, because these are institutional grade assets.
Right, and yeah, of course, as the deals get bigger, there's
No secrets, no
no
mysteries.
secrets. There's smarter people all focusing their efforts on that. So yes, unfortunately, you can't have it both ways. You can't buy in a fabulous growth market and also get positive leverage, right? That's very, very rare, like you said. So, and the reason for that, it's quite simple. People are willing to pay a lower cap rate for a stronger market like Dallas, here we are, because they're betting on the fact that the growth of the market is going to increase rents and increase their cap rate over time. So for example, instead of buying the 5 cap and then financing it at 4, people in Dallas are willing to buy the 4, or let's say buy the 3 cap with 4% debt. So they're buying on negative leverage.
So how do you make the deal work then? Do you have to put more cash down? How does the financials work when you have to do that, right?
Right. So I mean, there's a few different ways to do that, but I just want to make the example clear, right? When you buy on negative leverage, 3% cap rate, 4% debt, people in Dallas are making the bet that the growth of the market's going to take that 3 cap and go from 3 to 3.5 to 4 to 4.5 to 5, and they're going to eventually get to positive leverage, right? Nobody buys a deal in hopes of staying in negative leverage forever. I don't want to say nobody because California and New York exist.
And those people have, I mean, whiffed. There's people I've spoken with, some of our investors, and other people that you're seeing cap rates right now. There's a big broker that works in San Francisco that has something where it's like the cap rate's like, oh my God, because before it was maybe even negative or like there was nothing there. So it's interesting, you can't buy on cash flow forever because sometimes, when states aren't operating the most business friendly, money goes and flows where it's treated best, right?
Yeah, and that speaks to the fact that banking on appreciation versus cash flow is an inherently riskier strategy, right? Because you're delaying all your returns to this one single event in the future, whereas if you're buying for cash flow, you're getting a portion of that return every single month. So
how do you find a balance there, though? Because it is really difficult because, there's a lot of people say, hey, when you're young, always do the appreciation game, always do the equity multiple, cash flow is irrelevant, you're in your prime working years, and then when you get older, you graduate, maybe you do a triple net or something like that, you find some sort of avenue to, get a good yield, right? So how do you try to balance and manage that? Because it's tough, and it's a philosophy thing as well.
It is tough because you brought up a really good point. And so, my point was regarding risk, and then your point was regarding kind of investment preference based on, right, if you're younger, you don't need cash flow anyway, right? So it's kind of your investor profile, right? And so those don't necessarily have to match, and they can very well mismatch. And so I would say you're right. I mean, at the end of the day, if you are younger, that most likely means you're not relying on the cash flow from your investments, right? If you're retired and you're living off of your investment income, then you literally rely on your monthly distributions from whatever it might be, right? It could be dividends from stocks, it could be interest income from debt that you hold, or it could be multifamily equity that you own that provides monthly cash flow, right? So if you rely on it, then of course you should lean heavily into cash flow, which might lead you to not want to buy in a growth market like Dallas, and it might lead you to buy in Dayton, Ohio, right? We're just picking out small cities.
Right.
So that's just kind of the back and forth. And I actually made a video about this a year ago, which I thought was a very interesting concept, which is no matter who you are, you should never really seek to produce more cash flow than you need, right? I think that's really the key.
Can you unpack that a little bit more? Because that's it's a small sentence with a ton of nuggets and meaning behind that.
Yeah.
So please take your time to draw this out.
Right. So there's two main reasons for this, and we'll get into it. So when I say you don't want to produce more cash flow than you need, what that means is, let's just take the example of you, right? You don't need any of the income that your investments produce, right? Because you work for an income and you're using your income to pay for your life. So your investments are truly for future, right? So for you, it's most optimal to forego all cash flow because it allows for two things.
It's like the opposite pref play. Yeah.
Yeah, exactly.
Yeah.
Because it allows for you to maximize returns, generally speaking, right? Because the market has a trade-off, right? If you're willing to not have cash flow, that means you should get overcompensated with higher total returns. As an example, development.
I was literally just about to say that. So do you recommend me or someone who's in their 20s to, at this point, only invest in development, or maybe do a heavier lift in an equity multiple play in reference to perhaps the 80% occupancy plays before? Is that the smarter play? I know your parents dive into this a lot where they take like pretty big swings and risks in reference to how the property kind of comes in to start with, right? Is that the right play? What do you think is optimal, or is it just a balance?
Well, I think there's a balance is always good, but I think certainly for younger people, development is something they should look into for sure. I think it also depends on the access and your knowledge, right? If you have someone that you know and trust in that space, then investing with them in development could be a great move, right? And in the spectrum of value add, right? Not all value add deals are the same. Some are lower risk and higher cash flow. Some are more risky but have more appreciation, more future upside. So you obviously, if you're willing to forego cash flow, you should be compensated with higher total return, which is great for you, right? That's what you want. The other benefit is a better tax optimization, right? Because every deal is different, but generally speaking, things that bias towards yield, you're going to have to potentially pay tax on that yield. Whereas if you have no cash flow and it's a longer term play, those gains, when they're realized later, are taxed at long-term capital gains, right? So in the world of taxation, right, you want to delay paying taxes for as long as you can, and you want to pay at the lowest rate, right? So long-term capital gains tax rate is better than short-term.
So the ultimate play would be development into a 1031 exchange.
Right. 1031 exchange, amazing.
Yeah.
Also, I love 1031 exchange as a potential topic at some point.
That is a whole episode in itself. We're
Totally.
not going to get, we're not going to go there just yet. But yes, I love it. 1031 exchange is my best friend. This is my favorite combos. It's actually the combo to my front door of my house.
Now people know.
Yes, yeah. So
So
you want to come by, say hello.
So when we say you should never really seek to generate more cash flow than you need, let's talk about kind of like an in-the-middle situation. Let's say somebody who does want cash flow, but they don't need all of it. Let's just say there's a family out there and they want to be able to live off of their interest income or their portfolio income, right? And let's say their living expenses are $1 million a year, right? Let's just dream, right? They live a nice life. So you would want to have your real estate portfolio or whatever it is that produces cash flow to produce $1 million of cash flow and no more, right? The balance of those returns should be focused on value add or development or appreciation essentially, right? Because there's no sense in, if all you need is $1 million, there's no sense in you taking all your money, plunking it into a debt fund that produces 10% in interest income, and let's say all your money is $20 million, and now you're producing $2 million per year in interest income, right? Because, okay, great, you're making $2 million in interest income, but you're paying tax on that
active income, right?
Yeah, you don't want to do that. So you'd want
also,
to maybe invest.
There's no appreciation there. Maybe you have a sliver, a tranche there or so. But,
right.
And also, I mean, if you're younger, foolish play, I at least think, because there's no growth there. It's just, hey, it's a return. It's an awesome vehicle for many people, and maybe you want to have something there, and depending upon the liquidity, if you can't find a deal, it's an incredible outlet. Maybe it's an in and out play, if you will, as opposed to a long-term 5-year solution.
Yeah, when we talk about debt funds, I think thinking of them as an intermediate place for your capital is fantastic, right? You're looking for a good deal that might generate you 15, 20, 25% returns, but in the meantime, you can find a debt fund that you can invest in and earn 5, 6, 8%, right? And that can be a great place.
That's awesome. Well, to tie it back into, so the theme obviously to start, because we've gone on a tangent, is buying in hard points in all cycles. How do you find money and how do you find deals? So deals obviously go through brokers and stuff, but is there any difference, in this point of the cycle right now? I mean, how do you think we're going to navigate it as we, close out, the second half of the year and whatnot?
Well, I think H2 of 2023 is going to be more of the same, which is a slower market. I don't think there's going to be a ton of exciting opportunity. It's starting to trickle in, but by and large, there's not a ton going on. So we're going to stick to our underwriting strategy, source deals from the brokers, like you said, and keep our eyes and ears out for unique opportunities. What I think is going to become more interesting in 2024 are the more opportunistic opportunities. There's going to be deals that pop up. There's going to be more distressed sellers, and that's when relationships and being able to move quickly are going to matter that much more. Those things always matter, right? Relationships are always key, because when seller selects you, or more importantly, when a broker recommends that a seller selects you as the buyer, everyone's putting a lot on the line. The broker is putting their reputation on the line with the seller. The seller is putting their sale on the line with you. And then, of course, you as the buyer are putting your reputation on the line as a buyer, right? Because it only takes a couple times messing up a deal, and brokers are going to be unwilling to award you the deal, and that's it. It doesn't matter how attractive of an offer you put in, the broker is not going to go to the seller and recommend you. So performing is critical. So thankfully, over the years, we have performed as a buyer, and we have a solid reputation as a buyer. So the hope is in 2024, when these unique or more exciting opportunities arise, the brokers think of us, they pick up the phone, they call us because they know that we're not going to play games, we're going to give them a straight answer, and whatever we say, we do.
That's awesome. And then finding money, how does that shift with where we're at in this current cycle? Because no one wants to be the last person in the door who's holding the bag, as they say, while the market kind of fumbles and such, right? So what does that mean for us? Obviously diversity, and having great relationships and keep going, with people, and doubling down, and obviously enriching them. Tonight we're going to an investor dinner, of course, with LPs and capital raising partners and such, which is really exciting. I love that. And tomorrow we have a broker dinner, of course, for the closing. But when it comes to money, how does it change with where we're at currently?
So what's interesting is, as you know, we've been speaking with a lot of people in the market that raise capital, and they've been talking about how it's become harder to raise money in this environment. And I'm not sure why that is. It could be because people are just unsure about the economy, right? They're seeing the Fed raise rates, and they think there might be a recession, or they think we're already in a recession, or they just don't think the deals are good right now. So for whatever reason, some people are claiming that they're having a harder time raising capital. Thankfully for us, we haven't seen it yet on our end. And again, I don't really know what that reason is. Maybe we're just working harder, so that way we're still raising the same amount of money.
We're an interesting growth point, right? And people are starting to attract and come into us, fortunately.
Yeah. Right. That's another good point. I mean, that's what my sister was saying to me yesterday, that, okay, well, while maybe the overall market is declining and it's getting a little bit harder to raise capital, we're counteracting that with our firm-specific growth, and we're continuing to grow our relationships, and that's kind of counteracting against that.
And I do think that there's, as you mentioned, and we're going to get into this, 80% less deals. I don't think there's 80% less capital in the marketplace. There is a very solid delta right there.
Yeah, do you want to explain more about how that could lead to actually raising more money?
Yeah, absolutely. So essentially, if there's, about 80% less, there's 20% of the deals that are actually going through right now. But obviously a lot of the institutional players are out, but there's a lot of retail folks, a lot of people that are, making a lot of money right now, or have just dry powder, as they say, on the sidelines, ready to go. That creates a very fortunate environment, because if there's less people actually buying deals and such, well, there's people that still want to raise money or pushing through their goals. So there is a very nice delta, the positive leverage, if you will, the positive amount there that will flow into your deals if you have good deals and if you have a good reputation. But I think what's also been really fortunate for us recently, because I speak to a very wide array of people. I'm on the calls with you, I'm going to the Midtown private equity meetings, and I'm also talking to the guy that might struggle to make his first $50,000 investment. So it's a very humbling juxtaposition. But those people are still flowing, and there are still goals and monies to be had. And if you're a good sponsor and a good custodian for them, there's still opportunities to be had, and they want to get excited and to put money into deals. And there's going to be, gains to be had. But, with that said, it's really fortunate when we're kind of, coming, we haven't crescendoed yet, but we're kind of on the climb up right now. And we have a lot of very positive momentum, which has been very fortunate for us. But if you're newer right now, it's probably, I imagine, very difficult to get done. And frankly, you're taking a very large risk working with a less experienced operator, as opposed to someone like us who has track record, has economies of scale, efficiencies, and, can get things done, and has the the name. So it's really important that we have that. But we're kind of in the positive position there, where we're able to take advantage of that. But if we were at where we were 3 years ago in the market cycle, if we started this firm 2 years ago or a year ago, we might be kind of the people that are just kind of in mud, spinning, and not really going anywhere.
Yeah, it's very true, and that's why I want to get back to our topic, but that's why people always ask me, is it better to start a business like this when it's a hotter market and it's easier to raise capital, or is it better to start the business when the market's kind of down and you can buy better deals?
I have my answer. You want me to go first?
Yeah,
or you want to go first?
Go ahead.
I think it's way better, in my opinion, to start like right now, actually, when the market's leveled out, because, or not leveled out probably entirely. I mean, who knows where it's going to go, but
Sure.
if you could start in a 2012, because you're going to look like a genius, because every deal will produce, obviously, in the moment. You don't feel that way, or how could you possibly know that? But
Right.
people, you ride up with those folks and they appreciate you. And, if you do, call it 20 deals full cycle, you probably can get to a position where you're going to roll your investors' capital if they've gone, 400x into a very
400x.
safe, well, sorry, a 4x, excuse me.
Yeah.
Yeah, number's a little bit off, but if you could 4x it or something like that,
Yep.
you could just probably park their money into a very, 8% return deal, and they'd probably be really happy with it because of their past performance. So,
Yep, that's what we've seen. So yeah, it's a very fair point.
what's your philosophy on that?
Well, I think that it is better to start in a hotter market where it's easier to raise capital.
Interesting,
Because the
okay.
thing, to your point,
It's easy for me to say, yeah.
well, it's hard either way, but if you were to start in, let's just take 2000, the period between 2008 and 12 as an example, right, where it's a depressed market, where, things couldn't be more negative,
Right.
but you could close your eyes and buy any deal, and it would have been a home run, right? So
If you could get the capital
get the
and
capital.
get the debt, because banks were probably not the most generous with loans. Yeah.
Right. So what's interesting thought about that is probably the companies that survived from those circumstances are really just truly amazing companies,
They're
because
the JP Morgan Chase, right?
they were willing to
yeah.
struggle in that difficult environment to get off the ground,
Yeah.
right? So it's a really truly special that they are rewarded for struggling in that period, because then they get to ride up that entire wave and crush it for an entire cycle and really do well for themselves and their investors. But my thinking is that if you were to start a firm when things are hotter, you'll be able to raise capital more easily, which will get you kind of more off the ground.
And ideally, you have a couple, deals full cycle before that, the music stops and the cycle restarts, right? So.
Yeah, obviously you can never predict, but that's, if you can get the timing right, that's great. So we were talking before we got on that sidetrack, we were talking about
Finding money.
Right, finding money. Yeah. So while we're thankfully seeing success and raising capital, we've continued to grow our investor network and everything. I do believe that things are going to get worse before they get better. Right. Like I said from the beginning, people are already complaining or mentioning that they're seeing it be more difficult to raise capital today than a year ago. However, I think maybe even a year from now, it could be even harder. I don't know. Obviously, nobody knows, but over the next 6 to 12 months or something like that, I think we will start to really see sentiment decline, and a real recession will take hold, and that's when it's going to be hard to raise money.
And 2024 is going to be a wonky year. We have elections. We might get some rate cuts, but, election years are always kind of interesting. There's people on both sides of the aisle say this and say that. So it will definitely be a roller coaster of a year, but hopefully the other side will be really promising. Hopefully the nation prospers one way or another with whatever the results of that is. So, yeah. Do you have any final thoughts on this subject before we close out and segue to the next topic?
Well, similar to you saying that 2024 is going to be rough or shaky, that's what you're hearing people say, right? Is survive to 25.
Yeah.
Right? So if you are struggling, or you have a bridge loan problem and properties that are underperforming, it might get worse before it gets better, but if you can just have that light at the end of the tunnel of surviving to 25, you probably come out on the other side in very good shape.
Incredible. So I want to switch gears now, speaking of survive till 25 and whatnot, into something you mentioned earlier, which was distressed situations and, kind of debt notes coming to an end. So because transaction volume is down right now, I think we all knew, and many people involved in the space took on bridge debt and floating rate debt, which, was just the smart thing to do. And why would you not, especially when, the market, was in the position where it was, where rates got incredibly low. So On the note of, debt notes coming to the end, what does that look like? Because that's going to segue into the next topic as well. But there's a lot of people that think that, hey, maybe 2024 and 2025 will inevitably have more forced sellers. Like, for instance, the deal we're going into in Dallas here, that debt note is coming to the end, and they didn't really have many options but to sell and strike a deal relatively quickly, which we're really excited about. But with that happening, what do you foresee is to come? Do we think transaction volume, it's not just going to jump up to 200% or 180% because that delta is there, but are we going to see maybe in H2 and 2024 and beyond deal volume come up because there are debt notes that are coming up? I don't know if you've thought about that much, but how does that kind of land to you, and do you have any predictions for that? What do you think about that topic?
Yeah. So this concept of, oh, well, the market's going to crash and people are going to have to sell because their loan matures or rates float up, right? All those sorts of things don't happen overnight, right? You don't become distressed overnight. It's a long process.
People also don't admit they're distressed,
Yeah.
especially to their LPs a lot of times
Especially to their LPs.
until they go ghost on reporting and such, and they send a month ago or 2 months ago's reporting, and people call them out for it. Which I had a phone call yesterday, and someone said that, which is scary.
Really?
So don't do that.
You might want to share more about that in a second.
Yeah.
So, yeah, I think there's this idea that take the GFC, for example, right? Things got really shaky in the global financial crisis in 2007, right? But we didn't really see the big recessionary effects until later in 2008. So we're kind of in that no man's land period right now, in my opinion, where things are kind of, they're up and they're down. We don't really know, but there potentially will be that final kind of period where things actually do roll over, and that's...
They have to realize it one way or another.
Yeah, exactly. That's the psychological timeline as well, whereby people go, oh, everything's fine, we can kind of last, we might be able to make it work, and then things actually fall off a cliff, and then they finally recognize the fact, oh no, we actually are in trouble, we need to make a capital call, or we need to fire sell, and that's going to, like you said, spur transaction activity, right? People are going to become market sellers, and when someone says they're a market seller, that means that essentially they're willing to sell at whatever the market is willing to pay, right? Because right now we have very few market sellers. We have people who want to sell, they take the property to market, but if someone's not there to hit their price, they won't transact. So it takes a long time for people to realize that they are in fact market sellers, or for them to become market sellers.
Interesting. Do you have any other notes regarding that? I mean, do you think, how much more inventory will come to market, do you think, call it in the next, maybe not 6 months because it's too short of a horizon, but call it from 2024? Do you think we're going to have a large uptick? Do you think we'll have normality, if you will, in reference to deal flow coming up? What do you think that looks like? And will that cause the market to shift and change?
Well, 2024, and I don't want to do a ton of predictions, right?
Yeah, no one's holding a gun to your head.
It's interesting to think about all this stuff, but at the end of the day, I don't think it's actually that valuable for ourselves as well as for listeners to consider all these predictions, because at the end of the day, as you know, we don't invest based on these predictions, right? We are knowledgeable about the market, we're in the market, we like to think about the market.
Yeah, we cook with the groceries that are given.
Yeah, exactly. We look at the market and we take what the market is giving us, and we don't think, oh my gosh, there's going to be a recession, so we don't buy anything today, right? Even if we think there's a recession coming, we still want to be buying today because, number one, we don't know, and number two, you can still buy good deals, go through a dip, and then come out on the other side. So that's just a little disclaimer.
And that's also just working with a good sponsor. Like a good sponsor, for instance, you give a good or great, like I think we're a great sponsor. If you give a great sponsor an okay or good deal, you'll likely get pretty nice gains. If you give a crummy or a less than desirable sponsor a great deal, there's a chance that deal goes south really quickly. So I think that's also something to be noted as well. And that goes back to expertise.
Very true. So with all that being said, I would say that 2024 is going to have lower transaction volume than 2022 and 2021 and maybe even 2020, right? And remember, 2020 was COVID.
Right.
And that initially stifled. I mean, no deals got done for about the first half of the year.
Yeah.
Then people started going crazy a little bit at the end. So
Well, thanks to the economy just stimulating it and destroying, basically plummeting rates, right? So.
well, yeah, I mean
Yeah.
for sure. It
Yeah.
was actually a very interesting period of time where
That might be an episode and a case study in itself.
yeah. So because I just wish we had the balls to act in that time, because we, like a lot of people, were just being very cautious, and we were sitting on our hands. We didn't know if the world was going to fall apart.
We were a newer firm. They were 2 years young at that
We
point.
were
Yeah.
newer. We were very cautious. So, but the exciting part about that moment in time was rates drop, right? And rates can move really quickly, right? On the short end of the curve, the Fed can raise and lower rates, and that moves rates immediately. On the long end of the curve, bond traders can buy and sell U.S. Treasuries, and that pushes the yield up and down, right? And so that moves very quickly relative to cap rates, right? Cap rates take a long time to move because it's a reflection of buyers and sellers in the market. It takes months to close deals, all that good stuff, right? So in 2020, we saw rates plummet very quickly, and for a while, cap rates kind of floated lower with them. So if you acted fast enough, you could have bought at higher cap rates as they were slowly floating after rates had plummeted down, and you could have locked in attractive positive leverage. So
Right.
that's just a case study right there that if you have money and guts, you don't need much brains. You
Yeah.
buy. But obviously that's hindsight 2020.
Right. And you also earlier, I think probably 20 minutes ago, but mentioned distress in relationships. So one thing that I commonly get asked is, oh, do you ever buy properties from the bank or whatever? And then people think it's like a foreclosure, like a single family home in '08, whatever, and you're buying a house in, random place in Nevada and the person was bankrupt and you're buying it for, peanuts. But do we have relationships to banks? Do you think that's possible for us to get into? We're buying foreclosure. You talk about relationships and whatnot. Is that possible, or is there a myth you're about to bust here? Because I would really love if you could bust it, and I could just say, wait, then let me pull up a clip on an investor call. This is the case, and this is what it is. Because there's a misconception. So please clear the air on this.
Yeah, I mean, unfortunately, it's maybe not quite as simple as a yes or a no, but the funny thing is just because a bank is selling a deal doesn't mean it's a good deal, right? Like you're saying, there's this idea that, oh, well, if the bank took it back, that means they must be selling it for a great price,
What
right?
did Sam Zell say?
I don't know, what did Sam Zell say?
He said it's not about how well you buy a deal, right?
Howard Marks, I think, said that.
Okay.
He said, it's not,
It's in your book.
it's not how much you, we need to come back to that.
Yeah. But basically, the premise is how well you buy a deal, and that's just
Right.
depending upon the market.
Maybe it
and
was
such.
Sam Zell, but
Yeah.
it's not what you buy, but it's
How well you buy it.
How well you buy it,
Yeah.
something like that.
Yeah.
Yeah, that's a good concept.
Yeah.
So, I mean, we are in touch with our lenders, and going back to the COVID 2020 saga, we thought, oh my gosh, the market's going to crash, right? This is going to cause a market crash, everything that's going on, right? So what did we start doing? We started jumping on calls with lenders all over the country. We started talking to note brokers, right? So actually brokers that sell loans, because we were thinking, okay, well, we can actually buy loans, and then we can be the one to foreclose on the property ourselves, right? So we got all excited. We did all this work, called all these people, asked around, built all these relationships, and the reality was there was no distress, right? The reality was nothing ever happened in COVID because number
Quite the
one,
opposite,
quite the opposite, right? And that's because
In most markets. Yeah.
most people didn't anticipate the Fed injecting a ton of liquidity, or the government injecting a ton of liquidity into the market and inflating the market from there. But yeah, I mean, it was a crazy time where lenders were actually telling me, yeah, we'll sell you this loan at par plus 3, which means, let's say the loan is a $10 million loan for a given property. They would sell the loan for $10 million and plus 3% of the loan amount, right? So you're not buying a discounted note, right? Because that's the name of the game. You'd want to be able to buy a loan at a discount So that way you have a nice margin for error in case you do foreclose on the property. You have that margin, and also you can bear the costs of foreclosure. Or if you buy a discounted note and then the borrower pays you off at par, you make the spread, right? So if you buy a $10 million loan at $8 million and the borrower pays your loan off, right, you make $2 million. So that's a good business. But there was none of this during COVID. So going back to today, I question whether there's going to be a big opportunity to buy distressed notes or REO properties from banks and things like that. We're starting to hear of some. Actually, we might even go tour one while we're in town this week. But I guess to answer your question when investors ask, no, we've never bought a property from a bank, but we're in touch with our banking and lender partners.
Arbor and whatnot.
Right,
Yeah.
and a lot of those sales get brokered by the same brokers that show us deals that are regular properties on the market, right? So theoretically, we hope to be seeing some of these opportunities to the extent that they exist.
And speaking of Arbor, which I just mentioned, and speaking of opportunities, and speaking of foreclosures and banks taking properties, I must have received a dozen emails, and you must have received probably 24 and a couple of phone calls as well regarding the crisis and the crash that happened with the Houston sponsor, which obviously we're in the market of. We're Texas, we're Houston and Dallas only, but we have our, as you mentioned, our fingerprint mostly in Houston, and there was a entire sponsor crisis there. So I would love to just break that in. I think that happened maybe 3 months ago or 2 months ago or so. But I would love to, now the dust has settled more, love to kind of hear your take on it. What happened? What are the lessons? What are the do's and don'ts? And just why it happened.
Yeah. So there was about a 3,000 unit portfolio that was foreclosed on in Houston.
So 3,000 units, dollar-wise, what does that mean?
So I think the total loan, I'm going to get these numbers wrong, but I think the loan across the 4 properties was about $200 million. I want to say rough numbers, 200 million. So it's a big loan, and I'm not sure if it was a single loan that cross-collateralized the 4 assets or if it was 4 individual bridge loans. I'm not sure about that, but the lender was forced to foreclose on those properties because they just weren't able to meet debt service, and that's in large part due to the fastest rise in interest rates in history. Right, we've seen SOFR go from effectively 0 to now over 5%, and that's put a big burden on being able to pay your debt service payments every single month. The other thing to understand about this scenario, because to your point, why were people emailing us about this, right? In the middle of us fundraising for deals in Houston, right?
Yeah.
Because they think it's a systemic issue.
Correct. They think it's like, oh, well, all of Houston must be like this. And,
right.
Well, I'm watching too much news. I'm watching CNBC, and I'm seeing, stock market go down, this and that. So obviously people smell a little blood. Maybe there's panic and whatnot. So,
right. So with that in mind, yes, there is in large part a systemic problem, which is rising rates, right? Rates going from 0 to 5 on SOFR. But this property, or this portfolio in particular, had problems as well from the get-go before even interest rates increasing, right? Because operationally, this portfolio was struggling. So what you're seeing is if you have a well-performing property and what you're battling is rising interest rates, that's a struggle, that's a battle. But if you are struggling operationally, which means your occupancy is low, you can't get the rents that you projected, maybe you're struggling with collections, maybe insurance and taxes went up on you, right? So now your operations are struggling, and at the same time you're getting hurt on the debt side of the equation. That's a recipe for disaster where you can see pain like this foreclosure scenario. So that happened here in a big way.
Yeah, and then can you get into the capital stack on that deal? Because it was kind of interesting.
Yes, it is.
And
So,
this is the, I think, some of the meat and potatoes and the don'ts, if you will, for maybe the younger operator, the aspiring operator, or just people that are looking to invest. And your debt profile is uber important, especially in a shifting environment.
Right. So in addition to having a high leverage bridge loan on the portfolio, there was also preferred equity. Right. So preferred equity is basically subordinate debt that is placed on top of the senior debt. So you have your senior debt and then preferred equity, which stacks on top of it as more debt.
And was that soft or hard?
I don't know.
Okay.
But at that point, it doesn't matter because because at the end of the day, the preferred equity has a right to equity distributions before the common equity does, and in this case, all the equity, common and pref, was wiped out. So it didn't really matter, but it still speaks to the highly levered nature of the investment, which was one of the reasons that it failed, right? There's also other reasons, like I mentioned, the operational challenges. Some of these properties are challenging, which brings me to another example of not a foreclosure, but some challenges. And so there's another portfolio that I'm aware of in Houston. And again, this is not Houston specific.
We are in the weeds here. This is probably happening all over the place. Some things may have gotten a Wall Street Journal article that happened to have Houston on it, unfortunately. But since we are the experts of Houston, we are privy to such information and gossip, if you will.
This is happening all over the country.
Yes.
Houston's a fantastic market. It's very strong.
We love Houston.
But we have another example of some drama in Houston of a portfolio. And there's been a capital call made for the portfolio. And there's another capital call being made.
And what's their debt profile?
So I believe they have agency debt on these deals.
Really?
So I think they're in much better shape. I think.
But a double capital call is, I just think of, diluting,
Right. So I think actually some of the properties that weren't stabilized to begin with, they have bridge, and then the stabilized deals in the portfolio have agency. So I think it's a mixed bag. Some deals are okay, some deals are struggling. But the real gossip is the connection between Apple's Way, which is the sponsor that had the foreclosure that was in the Wall Street Journal, right? The 4 properties that we had just discussed, and this other portfolio. The connection being this portfolio over here had a problem property. And this problem property...
And were these properties bundled together when they got the debt?
I don't know the specifics about that. It's actually a portfolio that we had bid on as well. We had bid on it years ago, and
thankfully we didn't buy it.
Well, I mean, we weren't willing to pay, the highest price,
and for good reason. Yeah.
Yes. So the connection is that Apple's Way was or had the problem property under contract, and so this portfolio over here is hoping that this buyer buys their problem property, and then they can use the sale proceeds of that transaction to fund CapEx, fund debt service, fund replacement cap reserves, right, and kind of hopefully rebalance.
Which feels a little fishy and kind of shady and slimy, personally, when I think about that. It's all kind of a house of cards.
Well, the sliminess comes in when you hear about the fact that Apple's Way allegedly, was using investor funds to put the earnest money deposit down on the acquisition over here. And so
they weren't re-raising capital for their next endeavor, essentially, you're saying?
Well, I'm trying to remember the specifics now, but basically they were telling investors that they were raising money for a certain deal, when in reality they were using it to fund extensions on their purchase contract on this deal. And so in the end, those big foreclosures happen, all these things start falling apart, and they don't close on this deal. So the investors that were investing money into what they thought was a deal actually didn't become a deal, and the owner over here kept the funds because, as we discussed earlier on the show, a non-refundable deposit's non-refundable, right? If you don't perform on the contract and close the deal, you lose.
That's the seller's money now. Yeah.
So very scary stuff, and very sad to hear about investors getting caught up in that, right? And I don't know what the lesson is there, right? The lesson is,
I'm pretty sure they're leveraged to the gills. I'm pretty sure they had a bridge loan with mezz debt, and they essentially raised, I think, 10% of total equity,
right?
Which just goes back to and why this one happened with us we're raising, I believe, about 60% LTC for deals right now to make sense in the current
at the most.
marketplace. Exactly. So, and they likely massage their rent growth maybe 5 to 7 to maybe a percent around there, which doesn't make sense, as opposed to what we're doing is closer to 3%. When you already might say it's 4, we kind of shave down, if you will. So
It's always good to be conservative when you can be, right? But
yeah.
the reality is when the market is hot like it was, it leads to people like this getting really aggressive and creating very leveraged capital structures and, like you said, doing aggressive business plans where they're projecting rents to grow every single year by 5% or more. So yeah, it's scary times, but that was the little bit of gossip that I told you I would share on this. But that's crazy stuff.
Yeah. Well, we're real estate out for this show. We're done. I want to talk about something personal, and that is the gym and exercise. So I remember you showed me pictures back in the day. You were jacked out of your mind playing football and such. Now, as you transition, I know you tell me that you want to, I mean, your calendar sunk up to my calendar. So every time you have a phone call, you're supposed to be somewhere, whether it's been vinyasa yoga or going to the pool, I get the notification. So I see how diligent you are with your working out. I see you're going to Church Street for boxing and stuff. But what did you do back in the day for working out? How has it changed to now? And what's kind of your long-term goal for gym? And how does that, because for me, it's almost like a temple. It's like a place of work. It's like, me time. So I cherish it. But what does the gym mean for you? What did you used to do? And what do you do, are doing now? And what do you want to do moving forward?
Yeah.
A lot of questions there. So a lot to unpack.
No, it's a big topic. And I feel like for you, the gym is like more of a mental thing than it is a physical thing, right?
We'll get into me after, yeah. Because I have an interesting relationship, yeah.
You just love the gym and you feel so good and all that stuff. So, yeah, like you said, for me, I, at a very young age, started lifting weights. I want to say about 12.
Was your dad pretty into it?
Yeah, he was. Yep, absolutely.
So did he teach you? Because then didn't you have a garage set up where you had basically just the boys always coming over and just a bunch of dudes throwing around and pumping iron, probably watching Pumping Iron by Arnold and stuff. Is that correct?
Yeah, those are amazing times. So that's kind of more fast forwarding to high school where we were able to convince my mom to take over more of the garage and build out a more substantial gym. But yeah, the very early days was just a little bench in the backyard and some dumbbells and
prison style.
Away we go, right? And so always enjoyed working out, and that also connected well with playing football in high school. As you know, played quarterback in high school.
We spoke about that on the first episode, I believe. Yeah.
Right. So we won't get into that.
Yeah.
So yeah, that's been the gym routine. It's been kind of more heavy on weight training and kind of getting beefed up and stuff.
You don't like running because I'm a chronic walker, and you get shin splints every now and then, if I'm not mistaken. So you are quick twitch. I am slow twitch.
Right. I get shin splints, knees, hips. I mean, I can't do things for long distance. So unfortunately, but yeah, that's been my flavor. And then most recently, and I'll also add in because since you mentioned yoga, starting at 15, I want to say, I started doing yoga because I knew that it was a good thing to kind of balance out the football stuff, and being limber is good and helps prevent injuries and all that kind of stuff. So stretching is important. So I started doing yoga, I'd say, pretty early on, and I've tried to keep that habit up because I think it's a really nice counterbalance to a lot of things we do. So that's been fairly consistent. But the newest thing, as you know, has been boxing. Boxing's been amazing. It's kind of flipped my whole workout world upside down because.
So, and what muscles do you feel like get hit when you do box?
I mean, muscles, shoulders. You'll get sore and you'll feel that a little bit. But it's a different sore. It's a different workout completely, right? There's less hypertrophy, which is where you're actually wearing out your muscles and forcing them to build back bigger and stronger, right?
Yeah, you're splitting cells. Yeah.
Yeah, boxing is way more endurance. And also getting you to move fast, right? When you're just lifting weight like this, it's slow, it's boring, right? When you're boxing, you're throwing punches, it's quick and it's hard, so it's completely different.
Very cool. So that's what you're doing now. For the future, are you TB12? Are you looking for pliability? Are you still trying to put weight on? What does that look like for you? Also, how tall and what do you weigh? And how has that looked over the years? Because I think you're almost 200 pounds back in the day. You were pretty diesel.
Right.
Yeah.
Right. Yeah. So I'm 6'2", and I peaked at 200 pounds when I was just really bodybuilding like crazy, and that's just not a sustainable business model.
That is so funny that like, oh yeah, you're 200 pounds and like that's tough for you because it's like I'm walking around 2 bills right now and it's like,
Really?
yeah, I'm heavy right
Oh,
now.
wow.
We'll talk about
We'll
that.
talk about that. So yeah, no, I have a funny build where I'm pretty small, kind of where it counts. Like I'm not a big person necessarily.
I couldn't think of someone's clothing who could fit me less flattering than like your entire wardrobe, which is kind of funny. And like our likes of what we look for, like you like a very tight fitting shirt. I like a slightly looser fitting shirt, but it's just kind of funny. Just the body differences.
Yeah, yeah, everyone's got their preferences, but yeah. So being 200 pounds, the hardest part about it is just the kitchen. To carry that much muscle and to build that much muscle, you have to live in the kitchen. You have to have protein shakes, and I was drinking a gallon of milk a day. It's just
Sounds disgusting.
it's horrible.
Yeah.
You're constantly full, and it's a terrible feeling. So I'm so glad to be out of that mode and not live that way, right? And it's not sustainable anyhow. And I made a complete 180 because in the early stages of building Lone Star, I had to, of course, commit my entire life to the business, and so I didn't go to the gym for 2 years. I think for over 2 years I didn't go to the gym, which is crazy for me because I feel guilty if I don't go to the gym for 2 days, right? You probably have the same thing.
I feel terrible because I run, so it's like believe me, there is a runner's high, there is a endorphin rush that you get that is associated with working out. Working out for me at this point is obviously you want your body to look good, and for me, if I don't work out, I'm gonna get extremely heavy. That's just my body type. But it's also just the mind effect and how good you feel from the activity itself.
Yeah. Yeah, so for me, I think we have some similar habits as far as intermittent fasting and skipping breakfast and things like that. Like to me, that's such a more sustainable lifestyle and just feel better. I don't really love the feeling of being super full all the time.
No, you feel lethargic, you're sluggish, you're taking naps at noon and whatnot. And it's funny, you don't even drink coffee, which is crazy to me. Like I love my coffee and caffeine.
Yeah, no, it's funny how you can't really talk about the gym without talking about diet and stuff, right?
Yeah.
The gym is kind of boring compared to diet, right? Because there's only so many things you can do in the gym, right?
No one's curling differently, right?
Right.
There's the hammer curl, there's the whatever curl. It's like there's a couple forms of it, and that's it.
Right. You're either doing a cardio, which is for you swimming or running, and for me is boxing.
Or pickleball.
Or pickleball,
which is the greatest.
Amazing.
Yeah, the GOAT.
Yes, amazing. And then there's lifting weights and kind of building up, right? You can be doing whatever, pull-ups and stuff like that.
So you do boxing right now? Do you do yoga weekly? What does that look like for you? Other classes?
Try to do yoga weekly.
Tough though, because you got to be in New York all the time, and we travel quite a bit. That's why I actually started running, because running travels. You can't swim all the time. Not every hotel has a full-length lap pool and that amenity. In fact, essentially zero do. So.
Yeah, exactly. Yeah, and anywhere we go, you can run, and I can do my body weight squats and push-ups and my shadow boxing, and we're off to the races.
Yeah,
and you feel amazing.
Do you lift weights still or no?
Yeah, definitely.
So, I mean, the biggest thing I'm honestly kind of fearful of as we get into the next part of our life, which is, and we sound like old men here, which is sad, but I've had so many friends that have torn labrums, that have, hurt themselves physically from actually lifting, and the last thing I want to do is, be rehabbing a part of my body or and whatnot, or you think you're the tough guy and you throw up 100-pound dumbbells and you tear a pec, and next thing you know you can't do anything and you're SOL, and you maybe never regain that, or you've got a lingering injury for forever. So, do you lift like you used to? Like when you do it, like are you rep focused? How has that evolved for you?
Yeah, it's a great point.
Because we're not built the same. Obviously we're not old men here, but Father Time, as they say, is undefeated. Not all of us are going to have longevity like LeBron James, so it's tough.
And even if you are in amazing condition or you're young, the idea of lifting super heavy all the time, I think, is stupid. And I think I did a pretty good job of that, even kind of when I was really big and really focused on lifting weights. I think at the end of the day, I still tried to check my ego and lift what was appropriate, because that's just the easiest mistake to make, right? You're you're in the gym with your friends. Inevitably, there's going to be someone who's just stronger than you, and they're going to say, "Oh, what? You can't lift that?" All right, and then you're going to go for those bigger dumbbells. You're going to go for that bench press, and you could get hurt, right? So for me, if I can't do it 10 times, I'm not lifting that weight, right? And that pretty much keeps you safe.
And when did you start adopting that philosophy, or has that always been constant for you?
No. So when I was at my heaviest and lifting, I would go heavy, and
Yeah.
I would do like as low as 3 reps.
Right.
Very rarely.
Well, I mean, you were ego, or I think when you're a guy and you're 19, your testosterone's through the roof. You're ego lifting at that point, and you're trying to be the coolest guy in the room.
Right.
And no one's gonna out alpha you or be the macho man than you, right?
Yeah, but still, with that being said, rarely would I do a 1 rep max.
Right.
Which, to me today, why would I ever do a 1 rep max? Like, who am I proving it to? Is that even a good workout? Right? I don't know.
Yeah.
So that's kind of, I think, over the last probably at this point 6 years where I've really transitioned to saying, okay, I don't care how much weight it is, and also going to the idea of like out alphaing and stuff like that. Everyone's built different, right? Someone could look skinnier or weaker or what have you, but they just have different strength on them, and that's just how they're built, and they could lift more than you, right? So it doesn't matter if you work out every day, someone else could still show up and be smaller but be stronger, right? So everyone has their own body, and that's why ego lifting can be dangerous.
Incredibly dangerous, yeah. So I have a different relationship with body, all of that, because you've always been, the quarterback. You've, had that look always. Obviously, super athletic. I'm not unathletic. I was, a good baseball player, golfer back in the day. But I actually, senior year in high school, believe it or not, you know this story, but to those back, watching, some of you do if you know me for a very long time. But I actually lost 110 pounds my senior year in high school. So from September of 2011 to May-ish, I want to say like Memorial Day weekend of 2012, I lost 110 pounds, about 8 months. So I lost the first 70-ish pounds, I want to say, until December, and then the latter, or the following amount, I think the rest of the 40, the back end of those months. And that was a really crazy process. And people always ask, oh, well, how did that happen? It's like, well, I don't know how it got that bad, but you're basically doing everything wrong. So how I lost it was going calorie restrictive, 1,500 calories a day, swimming laps, and lifting weights in the morning and making that happen. And I rolled that into college, and I've been able to keep most of the weight off. And this is probably the heaviest I've been in over a decade. So I'm going to say this right now. I got about 15 pounds to lose to get to my, happiest body weight. But, I'm 6'3", 200 pounds right now. So I got some weight to lose. But, it's crazy. My workout and your workout looks different. I try to run 40 minutes every morning, and then I need to start incorporating a little more weight training, just because you just need to do that for your body and your skeleton and whatnot. But it's funny, everyone's body's different. That just goes to, swim, run your own race and do what's best for you and what makes you feel good. And I think you said this about maybe a month ago or less, but the best workout was the one that you always do. Is that what you said?
Yeah, the one that you actually do.
Yeah, exactly. So that's why, for me, I cater my workout around cardio, and then I try to get a lift in and whatnot after that. But, that's what makes me feel best. I used to swim a lot more, but swimming is just so gosh darn boring that it can be really just you in a black line trying to do 100 laps. It just can be defeating. Also, it's a process. You got to put, your swimsuit on. You got to get in the pool. You got to get out the pool. Sometimes it's cold. Sometimes it's too hot. If it's the middle of the day in Arizona, I'm just not going to fry my skin like that. My pool's outdoor. And then when it gets to December and January, it's 40 and 50 degrees outside in the morning. It's just not really fun. But running, there's a track indoor, or you go, and that's nicer. Fortunately, in Arizona right now, it's so hot in the morning. If you're not outside, before 11 a.m., you're not getting outside until 7 p.m., so you better get it in. So it's been really nice to channel my habits to do that every single day. Yeah.
Yeah.
Any other final wrap-up thoughts?
On the gym?
Or just this podcast, this episode?
No, I thought it was a good podcast. I think it was flowing pretty well.
Yeah.
Yeah.
Awesome. Well, if you have any questions about Lone Star Capital, if you're looking for information as to how you can invest, work with us, or learn any more information, or if you think someone would be a great fit for the show, please send them it. Also, if you know anyone that might be looking to invest as well, please think of us. That's how we're going to fund this bad boy, if you will. So hopefully you found this useful, and let us know if you have any questions.
Sounds good. We'll see you next time.
Yep.